Hello everybody, welcome to another update on the Gold Forecaster Index, the holy grail to predict gold prices. In my last video, I told everyone to hold gold. It had a positive momentum, although it was subsiding a bit. And apparently we have a rise here from 1600. It went to 1650 and went back down flat. And due to coronavirus fears, the gold price went up to almost 1700 right now. So yes, let's see what the new data point tells us. Our new data point says that gold is going higher. So this is still in the positive. That means that the trend is going higher. If it went to zero, then that means that gold will be flat. If it goes negative, then gold will fall. So we are still in positive territory, and I expect that gold will continue its rise upwards. Okay. Another interesting chart here is stock valuation chart. We have here the equities divided by the gross domestic product. And you can see here that stocks are still very highly evaluated here. So I expect that this will come down a bit in the next few years. Probably a decline of 10 to 20%. So we need to keep that in mind, that we are now significantly overvalued. And we also saw that stocks were starting a bear market in end of February. So let's see how that evolves. Also, a leading indicator that I like to follow is the credit spreads here. If you check this here, yeah, you see here that since 20 February we had a massive decline here between the 10-year and the AAA effective yield, and that shows us that GDP is going to crater. So something happened here. I don't know what, but in in the second part of February everything crashed. Something happened, I don't know what, but I'm going to expect here that GDP is going to crater. We also see that oil has been cratering. It's now probably $45 per barrel. Something here to see maybe. Yeah, you see here that at that point the CCC junk bonds here started moving up. So this is a sign of a credit freeze coming up. Okay. Whenever you see this line go up, that means that there are a lot of defaults happening. See, it's still moving up. It went a bit down here because the Fed intervened by cutting rates by 50 basis points last week. But the problems aren't going away because we see it go up again. So let's monitor this in the next few days. Let's look at the money supply. And the Federal Reserve has been money printing here. The balance sheet went up. Now the balance sheet is not going up that much. So let's look at the balance sheet here. Just click on this here, and then you have the balance sheets. Let's see where we stand now. Okay, this is, oh, we see a tick up here in the balance sheet from 4.158 trillion to 4.241. That's 100 billion increase. That's a lot. So we see that the Federal Reserve is increasing its balance sheet again to prop up the markets. They are just going to send money to the trading houses, and those trading houses will buy up stocks to support them. And the repurchase agreements here. Oh, you see here a huge rise in the balance sheet as well. 143 to 195. So yeah, the shenanigans are continuing here. Let's look at the inflation numbers now. So the last numbers here in January are positive for inflation. Producer price index is going up. CPI is also going up to 2.5% for the CPI. So that's all positive for gold. Capacity utilization has been crashing since the Trump tariffs in 2018. You would expect that inflation would go down, but inflation is still going up. So that's very interesting to see. But this clearly means that manufacturing in the US is not doing well, because capacity utilization is going down. We got good jobs numbers today. You can see that here, this red line in February. I think it was 270,000 jobs for the non-farm payrolls. That's a very good number. You can also see that in this chart. And this tells me that the unemployment rate will stay at 3.5%. So no problems here. So on the surface, things are very great here. But when we look at the amount of part-time workers, then we see what's going on here. Look at this. Since this year, 2020, we see that we see here a huge increase in part-time workers and a decline of full-time workers. Okay, you can see this here. And usually when this happens, like in 2008, then a recession starts. So this trend is a new trend, and we need to follow this up to see if this will continue. Okay. Okay, we also had a rate cut by the Fed last week by 50 basis points. You can see that here. They cut rates from 1.6 to, what is it, 1.1, a 50 basis point cut. And they really needed to do that because the 2-year yield here, 2-year yield has been crashing since February the 20th. Unbelievable. And they really needed to cut 50 basis points. And I expect more cuts to come because this isn't done yet. Still going down. So probably at the next FOMC meeting, they will cut another 50 basis points to 0.5 if this continues to go down. Very interesting to watch. We had new trade numbers. The trade deficit has actually sh shrunk a bit. You can see that here. January trade deficit was at minus 544 yearly. So that's an improvement. That also means that the currency, the US dollar, will be strong. Okay. The currency always follows the trade deficit numbers. Trade deficit numbers are improving here. So I think the US dollar will stay at this level. But on the other hand, we also need to look at the budget deficits, which are very high in the trillions. So yeah, this chart shows us that the US dollar will decline, and we'll see if that will happen. Just wanted to show you also the 10-year treasury here. Unbelievable how this declines here. And you can also see that the dollar has been declining from 99 to almost 95. Let's go over some posts. Yeah, the coronavirus is actually a thing that is almost like the trade war. So you have supply cuts, just like in a trade war. People will not trade with each other anymore. And then you have a decreased efficiency, and that means less productivity and higher inflation. So that's inflationary. And on the other hand, we have a decline in GDP, and that will show up as a decrease in the oil price. So we have higher inflation, lower oil price, lower bond yields, and that's typically very good for gold. And you can see here in this chart that gold is going up, oil is going down, and that should be a very good uh, for gold miners. So the gold miners fundamentals are getting better and better. So I would advise to get into that sector. European banks are very much in trouble because of these low yields. And the US yields are going to zero, but the European yields are going even lower. They're probably now at minus 1%. And that's very bad for European banks. And they have been crashing also. So these are the worst banks here because they have a book value less than 1. So these will crash first, like Deutsche Bank. They are in real trouble here. Good banks are like KBC here, Swedish banks. So these will probably live and these will die. Uh, just wanted to show you this chart as well. Something really bad happens in February. Global PMI has crashed. Also, China has shut down, and that's all due to the virus. So we are now in contraction below 50. This is also an interesting chart here. We had a small crash in gold last week due to margin calls. So this crash in gold should gap back up to go back to the 10-year yield, 10-year real yield. So 1,700 is a short-term target here. And this is the post about 50 basis points cut on March the 3rd. And you see that rate cuts are always good for gold. And more rate cuts are going to come in the next few weeks. Now, this is a chart. I said that Fed rate cut was locked in, and it did happen. Savings and housing, new correlation. You can read that. I mean, housing is actually a good investment right now because people still have a lot of disposable income. A lot of savings have not gone into housing yet. So I'm not that bearish on housing yet. Here you can see the PMIs crashing. Global PMIs are also crashing. So this is confirming that GDP will be lower in the next months. Pretty interesting post here on palladium and platinum. So different miners like Amplatz and Sibanye, they are starting to go from palladium to platinum. And as you can see here, the palladium costs have now gone up. And now we are at $200 per unit for palladium. And that's the threshold where the manufacturers are going to start substituting palladium with platinum. Also, Sibanye said here that all the lab work has been done. So substitution can come here uh, in 18 to 24 months. So maybe in 2 years we will go back to platinum, and it's a good investment now to be buying platinum. Also, Mark Faber has recently, like yesterday, he said that platinum is still very cheap. Gold has been moving up in SDR terms, and I think it will continue to move up. Yeah, probably this chart you have seen before. Uh, China problems here. China is completely shutting down here since February. Also an interesting chart here. The pension funds are all in bonds. Okay, these are treasuries, bonds, and the pension funds. Look at this. Since 2016, they have been increasing their positions in bonds. So this is actually very important. Bond yields cannot go up because if bond yields would go up, then all these pension funds buying these bonds will be, yeah, in the red. Because when yields go up, the bond value goes down. So they will all be out of the money and you will lose your pension. We also know that the Federal Reserve has cut its repo schedule. So the new schedule is 25 billion and then to 20 billion in March. So we are now somewhere here, 25 billion. And next week we will go to 20 billion. So I call this repo redux. And this has also crashed the stock market because there's less repo here. Then I want to mention also Peter Schiff vs Brent Johnson. So there has been a bet made between Peter Schiff and Brent Johnson, and Peter Schiff forecasts that the US dollar will be lower than 99 next year, while Brent says that the US dollar will be higher than 99 in February next year. So we will see who will win, and the winner will get one gold coin. And I actually think Peter will win because when you look at the budget deficits, this will continue to go up. Okay, and the US dollar will follow that budget deficit here lower. Yeah. Another correlation here that I found: profits before tax is a leading indicator for the stock market. So you can check this chart out. If this continues to go down, then stocks will crater. The USGS also reported silver reserves and production. So I wrote an article on that so you can read that. Apparently, silver production is going to go up due to increases in copper mining and zinc mining. And the silver reserve has also gone up. So this is actually not good for silver because production is going up and the reserves are going up. Let's take a look a bit at the COMEX stock levels. So here you can see that the registered silver stocks at COMEX are topping out here. And that's typically a good sign for silver. If this continues lower, then silver will start a move up. Registered gold is moving up, so that means that ETFs are buying gold here. ETFs are going up. If you look at the GLD, the stock level at GLD is actually very stable and moving higher. We saw a temporary decline in open interest, and that's also when gold shot up somewhere in beginning of February. A post about China copper traders who declare force majeure. Okay, so this is also very important. China does not want copper anymore. So the copper price is declining. The zinc price is also declining. And I see already that production is also declining because if China doesn't want copper, then the production needs to stop. Let's take a small look at the copper price today. See that it's declining. Here was a huge decline and it has not gone up yet. So China is not buying copper yet. The same for zinc. Look at this. Zinc is crashing. Long-term chart says a top at 1.6 and it is declining. So I expect that zinc production will also decline going forward. If China does not want zinc anymore, then nobody is going to produce zinc. Very important to know here is that when zinc and copper production goes down, also the silver production will go down. So that's temporary good for silver. Do I have any more posts here? Maybe this one. Okay, I see that silver inventory at the Shanghai Future Exchange is still going up here. And typically when this happens, for example, here in 2015-16, we saw a huge increase in the inventories. You see that silver didn't move up initially, but after a while, you see a delayed move up. So I'm going to expect here that if this continues to move up, uh, eventually this will go higher. So the silver price will go higher eventually, especially now when gold is at almost a new high in every currency at 1700. Okay, that's all for this video. Let's monitor what the economy is going to do in the next months. But I think the conclusion is that should be in gold. Gold is going higher as the gold forecaster index is indicating. Okay, I'll see you in the next video. Bye.